Okay, welcome back. I'm going to teach you the third setup. And the third setup is very powerful. It's kind of like a combination of the first setup and the second setup, but it has its own unique rule set. Remember, the green trade to go long happens when you have a group of dots that's higher than one group over to the left, right? And the short green setup happens when you have a group of dots that's lower than one group over to the left. The next trade looks at a higher level failed swing. For example, right here you see the price actually breaking this low swing level here. It comes down and it breaks through it and makes a new low. But it fails to get below the next dot over. In other words, the white trade, you would need to have it get down here, right? So that it's actually lower than two dots to the left. This is lower than one dot to the left, but higher than the second group over. It's in between, right? It's lower than the first group, but it's higher than two groups over. This is a second level failed swing. Or simply put, we just call it the purple trade. And there it is. It operates the exact same way as the green trade in that you don't need the high trend to corroborate. All you need is for the first group of dots to be lower than one group over and higher than the second group over for long trades. I'll show you a short setup in a moment. But notice that you have your green dots and the first green bar above the momentum line is your setup. And it produces a really nice trade. Look over here at the right edge of the chart. Notice there's a setup right here at the edge of the chart. Now, don't be confused. It has nothing to do with this three set of dots. Remember, you have to have the three dots already. This setup is corresponding to these dots. Remember what I said. The first green bar to close above the momentum line, and it could be on the third dot or up to 4 bars over. This one is 2 bars over. And notice you have 1 bar closing below the signal line. That's not enough to cancel the setup. You need 2 bars closing below the signal line. And that's after you have a setup bar. So this bar closing below the signal line happens before the setup bar. So that doesn't matter. Once you have a setup, if it doesn't trigger in and then you get 2 closes below the signal line, that would cancel the setup. So instead, this actually triggers in, right? You have the first green bar above the momentum line. You have the price pushing past the high of the bar, hitting the entry. Remember, the stop is down here at those dots, and you end up with a really nice trade. All three setups work the same way as far as needing to have that first green bar for longs or the first red bar for shorts, hitting the entry, where the stop is placed at those exhaustion dots, and then moving up, hitting targets. Here's another long example. You have a group of dots that's lower than the first group to the left and higher than the second group to the left. It's a much bigger setup. Notice how the price comes down and finds support on the 50 EMA. The first green bar, 1 bar over, gives you the setup. The price pushes up, hits the entry, and is able to make it to the first target. It's amazing how accurate these targets are. Developing on the right edge of the chart is another purple trade. Why is it a purple trade? It's the opposite of the long trade. Now you have a group of dots that's higher than 1 group over to the left, but lower than 2 groups over to the left. Notice it's in between. That's a second level failed swing. It failed to get above the second swing level up here. It was able to get above this swing level, kept making new highs, but it was not able to get above that swing level. And what I really should be saying is not swing level, but exhaustion level. because that's what is really pointing out to us. Exhaustion levels. The first red bar is on the actual third dot. So you should know that all we need now is for the price to push down and hit that entry. We're also looking for new setups. We're also looking to see if the bar closes above the signal line 2 times to cancel that setup. So we have 1 bar, 2 bars, 3 bars, and notice the price is below the momentum line the whole time. I'm not even looking at the histogram because it's not important. It's not part of the trade. Finally, on the 4th bar, it pushes through and gets short. That is an active trade. Now, see the second group of dots here is lower than this group? If we were to turn on the green trade, that would be a setup for the green trade. But we're only looking at purple trades right now. So we've built into the calculator the ability to turn trades on and off. Keeps things really simple. Look at how it pushes down and hits target 2 perfectly for a real nice trade. It even hits target 3 perfectly, right on the 200 EMA. And then it keeps going, at least for a little while. There you go. You've just learned the 3 types of setups that make up not only the Counterpunch Express, but the entire Counterpunch trading strategy. Now later on in this video training, we're going to go through some markets and walk through examples. We're going to put all 3 setups on the chart. We're going to walk through as if we're trading a trade plan, thinking it through step by step, trade after trade. We'll do a number of those walkthroughs on different markets so that you'll begin to see how it all works together and how we focus in on the proper trade in the sequence of trades that's set up. Okay, we'll talk about different considerations, and we'll even look at setups that we're just going to simply ignore, and we'll talk about why. But before we get to that point, let me explain to you now what an actual trade setup is. And we'll look at the exact same trade, the last trade we were just following here, this short purple trade, because all the setups are the same. I'm going to teach it to you on the purple trade, but it's the same on the white trade, and it's the same on the green trade. You see what I mean? The counterpunch is actually quite simple. So the way it works is like this. The entry I already taught you. It's the first red bar, either at the third dot or up to 4 bars over. Some trade plans might use 5 bars over. Other trade plans might only use 1 bar over. But the standard approach is 4 bars over. The next thing we need is for the price to move past the setup bar. So the typical entry for day trades is going to be 2 ticks below the setup bar. So see how this little plus sign is 2 ticks below the low of that bar? We need the price to push past the low of the setup bar to hit the entry. That's the last piece of confirmation. It's price action itself moving towards our entry. And some trades don't trigger in and go the other way and save us from what would be a losing trade. This extra piece of confirmation, price action itself, is critical to the success of most of these setups. Remember, we can't eliminate all losing trades, but this mere 2-tick move breaking out in the direction of our trade will eliminate many setups that we do not want to be in. And it will get us into many more setups that we do want to be in, putting the odds in our favor. Okay, so let's talk about targeting. Obviously, the targeting is calculated for us by the calculator, but it's important that you understand how the targets are being calculated. So let's take a look at this white trade as an example. And we're looking at a Euro-US Forex chart. But it's the same with every counterpunch trade. This is how all the targets are calculated. It's really simple. We're going to measure the highest point of the 3 bars within the group of 3 dots. Okay, so in this case, it's the first bar. In another example, it might be the second bar or even the third bar. It's the highest point of those three dots. So the high of that bar, it's the first bar, is 1.12885. Okay? And we are then going to find the low of the actual setup bar. So sometimes a setup bar might be on the third dot. Other times it might be on one of the bars to the right. Could be up to 4 bars, depending on what the calculator is set to. That's usually the default, as I mentioned. In this case, it's 2 bars over. And so we're going to measure from this high to the low of the setup bar. And that is going to be called the X factor. That's the multiplier that we use to calculate our targets. Then we take that multiplier and we subtract it from the low of the bar. If we subtract just that exact amount, it's 1x. So we would take 1x minus the low of the bar, and that's going to be right around this yellow line. Now I have these targets pushed down further. I have the targets at 1.5x, 2x, and 2.5x. Remember, the x is the distance between the highest point of those 3 dots, the high of the bar, right, of one of those 3 bars, to the low of the setup bar itself. Then we subtract it from the low of the bar to get our targets. In the case of a long trade, notice that the lowest point is on the first bar again, but the actual setup bar is on the third dot. So we measure the distance between that low point and that high point, and then we add it to the high of the bar. We don't add it to the entry. We're giving up a little bit of that X factor for the entry because that's the price we're paying for extra confirmation. All right, so we give up a little bit because it has to go 2 more pips to get triggered in. So remember, the calculation is added to the high of the bar. So 1x is going to be right up around here. In fact, let me move the targets down to 1x so that you can see. All right, well, I realize that happened pretty quickly, but hopefully you can see that the targets move lower. Okay, so now this target 1 is at 1x. And we could do a simple test. I can grab a trend tool, draws lines, and I can draw a line from the low of this bar to the high of the setup bar. I'm just eyeballing it, but that is the distance. That's your X factor. And then if I move that and put it right on top of the high of the bar, adding it to the high of the bar, in other words, you'll notice that it stretches right up to the target 1. You see how that works? That's 1x. Another half an x up is target 2. I could easily test the third target at 2x by just moving this up to the first target, and you'll notice that it measures to the second target. You see, so that is a visual way of seeing how the targets are calculated. You should also notice, I'm sure you have already, that the trade setups are different sizes because the Counterpunch Express is actually tuning itself to market volatility. Right? The measurement that we use will change from trade setup to trade setup. Notice a small trade here, a bigger trade here, a bigger trade still here, a nice big trade to the downside. Look how accurate that target is. Just stabbed right to it. You always want it to go a little bit beyond because that guarantees you'll get filled. Yeah, it keeps on going. That's where we're going to use our trailing stop. All right, but now you know how the targets are calculated. In a subsequent video, I'll teach you how the calculator works so that you can learn how to adjust those targets. I want to point you in the direction of this white trade. Why do you have an entry here with no targets, and then 1 bar over, you see the same entry, and then you see the targets? The reason why is because this is the actual setup bar that the targets are being measured from. You've got your 3 dots, you've got your measurement between your low to your high, you have it added to the high of this bar, but there's no targets. And the reason why is because this is a white trade, it needs one extra thing to happen. Remember what I said, if you look down on the histogram, the cyan line had not yet crossed over the yellow line. Remember, that's a piece of confirmation that has to happen for the counterpunch trade to become valid. It happens on the next bar, on this bar. You see? Just follow the axis down and you can see that it crossed over. And it has to close. So once the bar closes, then you see the setup come back and the targets. But the targets are not based on this bar. The targets are based on the initial setup bar. So with the counterpunch trade, you get a warning sometimes that a trade may be coming if the high trend turns, as it does in this case. Notice how the target gets hit perfectly. If you see how all these setups work from left to right, the first trade here is a green trade. Let me just roll it back a little. And you'll notice that this trade here is smaller than the next trade. And the reason why is because the measurement in the 3 bars is going to change from setup to setup. And this is part of the magic of how the Counterpunch Express is able to adjust itself and tune itself up to the volatility of the current market condition. And that's one of the things that makes these targets so accurate. Now you'll notice that this green trade actually failed. It was a losing trade. Losing trades do happen. However, if you were actually trading this market, chances are you would have taken the purple trade, which came before the green trade. Just depends. Depends on the trade plan. That purple trade did come up and hit target 1 perfectly. If you're in the purple trade, you're most likely not taking a second trade. So in a way, that green trade is probably not being taken and a losing trade is avoided. But let's just say worst case scenario, you did take the green trade. It was a loser. Look at the next trade. It's a nice winner. Look at the next trade. It's a nice winner. Look at the next trade. It's a nice winner. Even the green trade that follows gets past target 1. This counterpunch trade is clearly a losing trade. It triggers in and then comes down. It hits the stop. Remember I said the stop is at the exhaustion dots. The default for the stop is 2 ticks below the lowest point of those 3 bars. Right here it's the highest point of those 3 bars, 2 ticks above. Okay? That's where the stop is. And so you can see how you can get some really nice risk-reward ratios when you go past that 1x factor to the 1.5x and to the 2x. Believe it or not, this white trade is a trade that we would not take because remember when I first talked about the EMAs? And sometimes when the EMA is pushing down towards the 200 and it starts narrowing and narrowing, you get what's called the squeeze zone. And so we're going to use that to filter out some setups. And I'll teach that to you later, but I'm just going to point out to you that this trade gets completely avoided because of our squeeze zone filter rule. And again, I'm going to get to that. Since it's right here in front of us, I thought I would point it out to you. Remember, it's the combination of these setups, but not just blindly taking them in a vacuum, but taking them in a sequence as it relates to a well-defined trade plan with rules. When you put all of that together, you come up with a recipe for success. So now that you've learned what the 3 setups are, and you've learned how the entry is created, and the targets are created, and where the stop is placed, what do you do now once you get into a trade? What are the typical rules of managing a trade setup from start to finish? Let's talk about that next. All right, so I'm showing you the chart for the first time. We've been looking at crude oil futures. This is a 377 tick chart, but it could have been any chart. It could have been Forex. Like I said, it doesn't matter. This is one of my favorite charts to day trade. It just moves so well, and I like using the crude oil chart to teach the strategy because it gives a lot of setups. It's a very active chart. So we've been looking at crude oil. We will indeed look at other markets as well, and we will look at some setups on MT4 as well as NinjaTrader. But let's go ahead and click forward and look for the next trade, and then talk about how we actually trade the strategy. Okay? So the market's moving, and all of a sudden you'll see that there's a setup to go long. And you should recognize that as a counterpunch trade because it's in white, or just a white trade. And remember, It needs the histogram confirmation, which we get, and that's the reason why we have the setup with targets. By merely clicking on the setup, we can look over to the data window. Notice I've opened up the data window, and you can place this wherever you want, and your entire trade is laid out for you. Your entry, your stop, your targets. You don't have to measure the low to the high and add it to the high of the setup bar to project your targets. The calculator does it for you. You don't have to add 2 ticks above the high of the setup bar for the entry. You don't have to calculate where the exhaustion levels are and the stop levels are. The calculator does it for you in live time, making it very easy to trade. Same with the shorts. Click on the trade to the left, and notice that the entire trade is laid out before you. And we've laid it out intelligently so that the targets are in the direction of the trade. So if we're going short, you'll have your entry and the targets going down and the stop above. Notice that when we go long, you have the entry and your targets going up. So it makes it very easy. Your eyes get used to seeing it. Let's see what happens if this trade triggers in. On the next bar, of course, it does. Now, when you see this setup, you place your trade. You place a trade, what we call a bracket order. In other words, you should set up a template where when you place the entry, you also have a target and a stop attached to that trade. So when the entry triggers in, it activates your target and your stop. And we use what's called an OCO, order cancels order. So whatever happens with this trade, let's say it comes down and stops out, it will automatically cancel the target. Now we can target, or if it goes up and hits the target, it will automatically cancel the stop. Okay? We never enter a trade without the full trade placed. You always want to trade with your stops and targets. Just make that a habit. Okay, this is good sound trading principles built into the strategy of the trade. Now you could target 1. Pretty good odds. Target 1 is going to get hit more often than target 2 and target 3. However, target 2 and target 3 get hit often enough and you get a much better risk-reward ratio. So we always use target 2 as our default target for a single position trade. All right. Again, you could always trade multiple positions and exit at each one of the targets. Normally, I'm going to recommend that you exit at target 2, maybe a second position at target 3, or you could even trail. And I'm going to teach you techniques in trailing shortly. So now that this trade is triggered in, how do we manage it? Well, we don't do anything. The trade is triggered in. We had our trade placed. Our target is in place. Our stop is in place. Now we just have to let the trade develop. This is hard for a lot of people. So you have to practice this. This is where discipline comes in, and this is where the whole idea of operating on a higher level, being the operator of your trade business, facilitating your trade plan, is where you want to be. You don't want to just be some person trying to trade, because you're always going to freak out when it triggers in and then starts going against you. Oh no, I'm losing. Maybe I should move my stop. What do I do? You don't do anything. You just let the trade play out. Remember, the odds are in your favor. Goes up, goes further. Ultimately, it comes up, hits target 1. Now what happens when it hits target 1? Usually when it hits target 1, we've earned the right to either reduce risk or eliminate risk altogether. One of the key principles of the counterpunch trader is to try to put you in a risk-free position as quickly as possible. And we're going to use that with the Counterpunch Express as well. So we're going to move our stop from here, and we're going to move it and lock in 1 tick of profit to here. Now you have to do that in your trade platform. You move your stop and you change it. So we know that the entry was at 45.87. We've hit that first target, and now we're going to move our stop to 45.88. So if the price comes down and works against us, we know we have our commission covered. We're in a risk-free position at this point in time. Now, we're also going to begin to implement our trailing strategy. And what we're going to use to trail is the signal line itself, because that's such a great momentum indicator showing us the balance point between buyers and sellers. Remember that. So what we're going to do is, once that target 1 is hit, we're going to now place a stop 2 ticks below the signal line. Okay? So we're going to lock in 1 tick or go 2 ticks below the signal line, whichever locks in the most profit, whichever is higher. So here the signal line is at 90, right? After it's hit target 1, signal line's at 90. So we put our stop at 88. Well, that happens to be where it's at anyway. But what happens on the next bar? On the next bar, it closes even higher. The signal line closes at 92. So we go 2 ticks below. You'd put it at 90. Now, I'm personally going to put it at 89 because I'm going to work around what we call key levels and chart levels. And I'm going to teach you that in a little while, but just remember the basic principle of the strategy is that it wants to stay in the trade while mitigating risk. And we're going to apply a 5% art factor to trading. There's a little bit of art to trading, but we're going to reduce it to rules that you can follow. Okay, so I'm just introducing these concepts for the first time as we simulate a trade, as we manage this trade going forward, and I'll continue to expand on these principles as we go. Okay, but remember, the main thing is we hit that first, what we call money management level, which is usually target 1. There are times when it might be even before target 1. There are times when it has to be target 1, but it also has to have gone a certain amount of ticks, like 10 ticks. It depends on the trade plan. But for the simplicity of just walking through an example, we'll just say target 1 is our money management level. And at that first money management level, we're moving our stop, we're locking in a tick, and we're also trailing the signal line. And with every bar that closes above the signal line, we're going to be putting our stop 2 ticks below the signal line. And like that, we can trail it up. So it's moving up. The stop is moving up 2 ticks below that signal line, and it ultimately comes up and it hits target 2, and you exit your trade for a full target 2 winner. Now, if you're in a second position, well, your second position is protected by the stop here, right? Worst case scenario, it comes down and stops you out, and you still get a little bit of profit, a partial profit. You might be holding a second position to try to get to target 3. You might be holding a second position to actually trail the signal line. You might even be holding 2 extra positions, one at target 3 and one to trail. It's really up to you. It's very flexible. Notice that is still holding. The signal line moved higher right here. It's all based on the last bar that closes above the signal line. So this bar closed above the signal line. The signal line moves up to 46.01, so 2 ticks below that is 45.99, and so we can move our stop to 45.99. I'm using this little green line here just to show you where the stop is. Of course, you're going to be moving it in your order platform, whether it's on the TradeStation Matrix, on some sort of MT4 interface. I like to use myfx.com as an interface with MT4. We'll talk about that in a bit. Or NinjaTrader on the Dome. You're going to move your stop to 45.99. Of course, with MT4 you can't trade crude oil futures, but it's the same principle with Forex. Look what happens. The stop holds and the signal line moves higher. And so we want to read what it is. It's 46.05. So our stop is now moving up to 46.03. And little by little, we're trying to stay in the trade while mitigating risk. Now, we don't even have any risk, but we're mitigating the profit that we made. I mean, that's still at risk. because if it comes down, we make less profit. If it goes up, we make more profit. So we're trying to stay in the trade. Notice that when I put my stop at 46.03, I've got two low bars here, and those lows are at 46.03. So doesn't it make sense to put my stop one tick lower, just in case the price comes down and tests that level and then goes higher? I'm going to make that adjustment every time. It does come down, it does stop out, and that's the end of the trade. It almost got to target 3, but it's a very profitable trade. And that's how we manage the Counterpunch Express. What I just taught you in this example is how you're going to manage every trade. And you've pretty much learned the strategy. Now, of course, there are some nuances. There is the art of trading. There are ways we handle certain situations. And there are some filters. Finally, there's a whole nother way of trading the Counterpunch Express. I've been teaching you the standard approach. Another name for it is standard mode. There's another mode that we like to trade certain markets called trend mode. And again, it's using the same principles. It's using real smart confirmation information that help us put the odds in our favor with our trade setups. I'm going to teach you trend mode in a little while. But in the meantime, I want you to think hard about what I've taught you so far. Maybe go back and review it again so that you really understand it. And then, of course, in the next video, we're going to move on. So I'll see you on the next video.